Good evening, everyone, and welcome. My name is Nancy Duffy, and I'm delighted to be here alongside Deirdre Kamlani this evening. We are both members of the program committee and the board of directors of the League of Women Voters of Greenwich. On behalf of the League, it is our pleasure to welcome you to tonight's program, Tariffs, Taxes, and the Trump Economy, featuring our distinguished speaker, Larry Kantor. The League of Women Voters is a nonprofit, nonpartisan organization dedicated to empowering voters. Our goal is to ensure that every citizen has the knowledge, confidence, and opportunity to participate actively in the democratic process. The League does not support or oppose any candidate for political office. Tonight's program is a part of our educational mission to expand voters' understanding of current issues. Before we begin, I'd like to thank several individuals for their assistance in organizing tonight's event. Special thanks to Helene Weiner, our communications director, Deirdre Kamlani, who carefully reviewed and prioritized your pre-submitted questions, Chris Lowe and Melissa McClammy, co-chairs of the program committee, and Jess Reed of Greenwich Point Marketing for managing our Zoom platform. Here's how the evening will unfold. Following Larry's talk, Deirdre and I will moderate a Q&A session alternating between questions you submitted during registration and any live questions submitted during the presentation using the Q&A function at the bottom of your screen. Tonight's talk will be recorded and available on the League's website for those who were unable to join live. Now it is my honor to introduce tonight's speaker, Larry Kantor. We are deeply grateful to him for sharing his time, expertise, and insights with us. Larry Kantor is an operating partner at Atlas Merchant Capital, a private equity firm in New York, and serves on the board of Ideas 42, a nonprofit dedicated to applying behavioral science to solve social challenges. Larry's career includes over a decade as managing director and head of research at Barclays Capital, where he was a member of the investment bank's executive committee and a frequent guest on media platforms like CNBC, Bloomberg TV, and the Nightly Business Report. Before joining Barclays, Larry held key roles such as head of foreign exchange strategy and chief European economist at JP Morgan. Earlier in his career, he served as chief economist and strategist at Normandy Asset Management, as an economist at the Federal Reserve in Washington, D.C. He began his professional journey as an assistant professor of economics at Lehigh University. In 2016, following his retirement, Larry was named as an Advanced Leadership Initiative Fellow at Harvard University, focusing on leadership and social impact. He is also a frequent speaker at the Retired Men's Association in Greenwich. Larry holds a bachelor's degree in economics, Phi Beta Kappa, from Rutgers University, and both an MA and a PhD in economics from Ohio State University. With such an impressive background, we are fortunate to have Larry here to provide his perspective on this timely and critical topic. As evidenced by over 350 registrations for this event, there is clearly great interest in tonight's discussion. Larry, we are excited to hear your thoughts. Over to you.
Thank you, Nancy. I've had the internet went out of my house. I switched locations. I may freeze up my video every once in a while, but I hope you can hear me. Just signal if that's not the case. An honor to address the Greenwich League of Women's Voters. I have a huge amount of respect for this organization, the work that Nancy does, Deirdre, Sandy Waters, everybody, and I love what they do. And so it's, again, it's an honor. So I've been asked to discuss the impacts of President Trump's economic proposals. I'm not a political analyst, so I don't have any special insight on whether he's going to do what he's proposed, nor whether he'll be able to execute what he wants to do. But what I can do is outline the major plans and explain what I think will be their likely effects. My views are strictly from the point of view of economic and empirical analysis. I mean, I have political views, of course, but I put them aside when I do my economic analysis. And that served me well in my career. When I worked at the Federal Reserve Board in Washington, political bias was just not tolerated. And it's not helpful. As a Wall Street analyst, you get rewarded for providing analysis that helps, in my case, institutions, um, financial institutions, to make wise investment decisions. And political bias is actually counterproductive. So you got to just be objective. I think to start off, it's worth just talking about where is the economy now. President Trump, as you know, has just taken office. Um, and despite what a lot of people think, actually, the US economy is in very good shape. It's been outperforming almost all other countries. Real GDP growth that's adjusted for inflation has been running about 3%. The unemployment rate's 4.1. That's very low, consistent with full employment. Inflation is, I know it's been cited as a major issue for many people, but actually it's been running around 3% following a COVID-induced surge that took it at one time to 9%. And it's true that most people have cited inflation as, their major concern about the economy. And that's because people are more concerned about the price level than the rate of change, which is what economists focus on and what inflation is. And prices, the level is a lot higher than it was a few years ago, as I'm sure you all know. When COVID hit, spending on services declined dramatically. People stopped traveling. They stopped going out to restaurants and entertainment venues and elsewhere. And along with massive fiscal stimulus in response to the COVID pandemic, this left households with a lot more money to spend on goods. And so they responded by buying lots of TVs, office equipment, exercise equipment, all kinds of stuff to try to make home life more comfortable. This occurred just as goods production collapsed because of worker shortages. Nobody was going out, shipping clothes and all kinds of things. And I'm sure I don't have to explain that when you get increased demand and you get a constrained supply, prices surge. And that brings me to something I say frequently, and that is presidents tend to get far too much credit and blame for the state of the economy. I mean, the executive branch of the government, as powerful as it is, usually plays a relatively small role in the state of the economy. There are exogenous factors. Obviously we had the pandemic, there's weather, there's all kinds of things. There's monetary policy, which is independent, which typically has actually a bigger near-term influence on economic activity than fiscal policy. And most importantly, there's a business cycle that reflects billions of transactions every single day. So now President Trump initially promised to bring prices down, but more recently he acknowledged it's going to be difficult. It might surprise you to hear me say that we should avoid an overall price decline at all costs. Deflation is very damaging and it's very difficult to escape from. The US experienced a long period of declining prices during the Depression. It lasted a decade. The unemployment rate went up to 25%. Not good. More recently, Japan experienced deflation for around 15 years after an asset bubble burst in the early 90s. Japan's economy stagnated. It took, here's a crazy number, almost 35 years before its stock market regained its peak in December of '89. That just happened last year. Not good. Inflation's not good. Now, here's why. When prices decline across an economy, it encourages people to save instead of spend because the purchasing power of cash increases over time. So you're incentivized to wait to buy things. This produces a vicious cycle of declining spending, declining income, declining wages, and it's very difficult to escape from. Even if you get interest rates down to zero on a real inflation adjusted basis, when inflation's going down, they're still positive. In other words, why borrow if you have to pay back in money that's worth more than when you borrowed? Meanwhile, a shrinking economy causes tax revenue decline, and that makes it difficult to enact fiscal stimulus. So the president's made a lot of proposals on a lot of different things. I'm going to focus on his economic agenda, which I've placed into three categories. I had deregulation, but I don't think there's going to be enough time. I want to leave time for questions, so I'm going to skip that for now. I'll start with tariffs. It's a keystone of President Trump's economic agendas. I'm sure you know, I think he's called himself the tariff man. It also conveniently provides a window into how economists analyze things. Trade of one kind or another is basically what economics is all about. So President Trump has already announced an intention to propose new tariffs on Canada and Mexico of 25% effective February 1st. He issued a memorandum yesterday called America First Trade Policy. He's directed certain agencies and departments to investigate trade practices. So it's coming. Now, they're an impediment to free trade. The vast majority of economists, that includes me, oppose them in almost all circumstances. So a simplistic way to explain this is that no one forces people or countries to trade. So if it wasn't mutually beneficial, they wouldn't do it. When you buy something, it's because you think it's worth the money for what you're getting, or you wouldn't buy it. And it's the same for the seller. That doesn't mean there aren't trade-offs, of course, or pluses and minuses. You end up with less money, seller ends up with less product to sell, but you do it because you both think the net value of the trade is positive. Now, it's more complicated when you're talking about countries trading with one another. The trade-offs are more nuanced, so is the politics. The counter, but I apologize, I keep freezing here. I don't know how good the internet is in this room I'm in. The trade-offs, so the counterparts in international trade, which of course are importers and exporters, both think they're better off or they wouldn't do it. So it's the same thing as individuals. But it often has positive and negative effects on different sectors of the economy. In other words, there's winners and losers. That said, almost every economic study concludes that the US is much better off because of international trade in terms of overall economic output, in terms of employment, and in terms of inflation. So as you probably know, international trade took off in the mid-1980s. It reflected both broader acceptance of free trade as beneficial and also the opening of the communist bloc. The US became a major importer of manufactured goods and exporter of technology. Manufacturing employment in the US declined dramatically. Many towns and cities that once thrived by hosting manufacturing firms were hollowed out. On the positive side, though, hundreds of millions of Americans buy cars, TVs, cell phones, washing machines, millions of other goods for much lower prices than they otherwise could. This allows them to spend more on other things, like streaming services, cell phone services, travel, going out to restaurants, bars, salons, whatever, gyms. And that provides additional jobs in these other industries. Still, it's true, many Americans seem to have a dim view of this transition because the loss of manufacturing jobs and the hollowing out of towns is much more visceral than lower prices on a vast array of goods. Similarly, the word deficit has a bad connotation, but have trade deficits really been a bad thing for the US? I mean, it's true. What it means is we import more goods and services than we export. And most people think that means foreigners take our jobs. That's a fact for certain sectors of the economy. China and many other developing countries have massively increased manufacturing employment at the expense of those same jobs in the US. But the lower prices of manufactured goods have allowed Americans, as I said before, to spend on other things. And that's actually created more jobs in other industries that have been lost in manufacturing. But there's another, I think, much less obvious benefit of international trade that maybe you haven't thought of. Did you ever wonder, I'm an economist, so I have, but how we can have such a low saving rate, lower than most other countries, but a very high level of investment. After all, countries need saving to fund investment. So why is this? It's because the opposite of the current account, which is for goods and services, something called the capital account. What's the capital account? That's the trade balance for for assets, right? So foreigners buy much more of our assets, especially financial assets, than Americans buy of theirs. Roughly 1/3 of US government debt is held by foreigners. This bothers a lot of people. But from an economic point of view, it provides us with a huge advantage. The supply and demand for loanable funds is what determines interest rates, right? When foreigners buy our US financial assets like treasuries, like corporate bonds, like mortgage bonds, like stocks, the supply of loanable funds in the US increases. This lowers interest rates below what they'd otherwise be. It provides more funds for investment. This allows Americans to spend more and save less, which boosts our economic growth, and still enjoy the benefits of investment, especially in technology. From an economic point of view, we should be more upset about Americans investing in other countries than foreigners investing in ours, which also means that foreign countries have a stake in US economic growth and safety. Just think about it. Over 90% of Americans were farmers at the time of the American Revolution. If that was still the case today, we'd be a very poor country. It caused a huge social upheaval in the way people lived as people moved away into cities instead of spending their lives on farms. And there are obviously social costs with these transitions that are hard to measure. I would say economists probably don't take enough account of them. They try to measure them. But I'll tell you this, the ability to adjust to significant social change as a result of new technology and means of production has been absolutely critical to the success of the American economy. Now, the results of our recent election seem to reflect a nation that has turned inward. Support for immigration and providing resources to other countries for defending democracy seems to have declined. The Biden administration recently blocked Nippon Steel's acquisition of US Steel, and President Trump, as well as candidate Harris, both said they were against the acquisition. The US steel industry, as you probably know, has been losing market share and shrinking for decades. US Steel now employs a little over 20,000 people. That's down from a peak of 340,000 many years ago. The purchase would have been US Steel's salvation. Local union workers were overwhelmingly in favor of it. Nippon's offer was $18.9 billion, and it committed to a $3 billion investment in US Steel's American plants, as well as guarantees to increase US steel production. It even proposed giving the US government veto power over any reduction in US Steel's production capacity. US Steel now says that without the purchase, it's going to kill 3,000 union jobs and move out of Pittsburgh into non-union Arkansas. What was the reason given for the sale blockage? National security, despite the fact that this purchase was a Japan company and Japan's an ally. The real reason, by the way, the Committee for Foreign Investment in the US found no security risks. In my opinion, the real reason for the blockage is that foreign ownership of US assets is unpopular. Okay, so enough of the economics lesson. What would the tariffs proposed by President Trump do, and how would they work? So I've explained why economists like free trade. Trump has made numerous tariff proposals, and it's difficult for anybody to predict the extent to which he's really going to deliver. He's argued for 60% tariffs on Chinese goods, 25% on Canada and Mexico goods imported into the US. By the way, these three countries are the US's biggest trading partners by far. Over half of our imports, 56.4% to be exact, come from Canada, Mexico, and China. The president's also proposed 10 to 20% tariffs on all other imports. For comparison, right now, the average tariff on all merchandise imports is 2.3%. So this is a big hike they're talking about if he does it. Now, there are many people, including some of Trump's advisors and nominees, who believe that a good portion of these tariff proposals won't be put in place and instead be used to extract concessions from our trading partners. More recently, he talked about restrictions on drug trafficking from Mexico and Canada. That said, and it may be true, it seems likely that tariffs are going to be higher than they are now and increase more than they were in the first Trump administration, given the emphasis President Trump has placed on them among his policy priorities. Now, President Trump claims that foreign countries are going to pay for these tariffs. The fact is that they're charged as a percent of the price that the importer pays the foreign seller. They're collected by customs and border protection agencies at 328 ports of entry across the country. Much of the increased cost to these importers are passed along in the form of higher prices to consumers. We've already reviewed the benefits of free trade, and tariffs would amount to a major barrier in terms of cost. Additional economic damage is typically caused by retaliatory measures taken by the countries where the U.S. imposes tariffs. The most infamous example of this is the Smoot-Hawley Act of 1930, which was legislated with the goal of protecting American farmers and other industries from foreign competition. What happened? It increased import duties by 40 to 60% on average. It provoked massive retaliation by other countries that resulted in a global trade war. It reduced global trade by some 60% and significantly worsened the severity of the Great Depression, both in the US and the rest of the world. To say it didn't work is an understatement. Now, President Trump did increase tariffs in his first term, and President Biden not only maintained them, but added some. While the current proposals calls for much larger increases, the experience with those tariffs gives us some evidence of their effects. Empirical studies have shown that they raised prices, reduced output and employment, did not boost the manufacturing industries they were meant to protect, but they did raise some revenue. So the tariffs in Trump's first administration were narrowly focused on certain products and countries. They were imposed on solar panels and washing machines in January 2018 and steel and aluminum in March of that year. What happened? Steel prices rose 9%. Jobs in the U.S. steel industry barely budged at around 140,000. Moreover, and this is important, these tariffs were met with considerable retaliation. The EU imposed tariffs on our steel, aluminum, agricultural, and food products, on whiskey, blue jeans, and motorcycles. President Trump subsequently imposed tariffs on $162 billion worth of Chinese goods, imported goods from China, between July 2018 and September 2019. Each escalation was met with retaliatory measures by China, with tariffs placed on agricultural products, including soybeans and pork. The retaliation from China and the other countries had significant negative impacts on U.S. employment, especially in farming. This was partially offset by billions of dollars in government aid to farmers. But you don't have to be an economist to understand that taking damaging action to an industry and offsetting it by government spending funded by people's taxes and debt doesn't make a country better off. Instead of protecting the manufacturing industry, it ended up producing a manufacturing recession in 2019. Employment in manufacturing fell by 48,000 from January 2019 to February 2020, when COVID hit and destroyed jobs in industries across the country. The Biden administration kept most of the Trump tariffs in place, and in May of last year added additional tariffs on around $18 billion of Chinese goods, basically semiconductors and electric vehicles. Now, as I said before, the tariffs did raise revenue. Tariff revenue has been running about $80 billion a year in the last few years. Before the Trump administration, it was around $40 billion. Now, if you take a 60% tariff on all the imports from China, that would generate some $200 billion in tariff revenue. And a 10% across the board tariff on all imports would generate another $250 billion. Now, that said, the revenue raised from even these extreme tariff increases would not be nearly enough to replace what we get from income taxes, an idea that President Trump has floated. Tariff revenue in fiscal 2024, which happened to be 77 billion, amounted to a little over 1.5% of federal revenue. An additional 450 billion, if he goes all the way, would be a significant addition, but it would still pale in comparison to the revenue we raised by personal income and payroll taxes, which is 2.4 trillion in the case of income taxes and 1.7 trillion for payroll taxes. So there's no way it replaces income taxes. Now, there is little doubt that the huge tariff increases proposed by President Trump would significantly reduce GDP and employment, and would cause a notable rise in prices. There are a bunch of research institutes that have run this through, like the Peterson Institute. The estimates are that if Trump does all these tariffs, it would reduce GDP by about a full percentage point as soon as next year. It would raise the inflation rate by about 2 percentage points, assuming there would be retaliation, which always seems to happen. So if that's the case, if they're so bad, why are they supported by so many people? Well, there was a study by economists at MIT, Harvard, the University of Zurich, and the World Bank. And what they found was that support for Trump and Republican candidates in the areas most exposed to the tariffs actually increased. So even though they failed as an economic policy, tariffs, at least in the first term, succeeded as a political tactic. Now, you may react to all this by saying, hey, the economy performed well during the first Trump administration, at least until COVID hit, and that would be correct. In fact, the trends in GDP, employment, inflation, and the stock market basically continued improving, along the trends seen in the Obama's second administration. And as we noted earlier, there are many other factors, that have a bigger impact on the economy than presidential actions. But it's also important to point out that the tariffs imposed during President Trump's first term were much narrower in scope than what he's now proposing. Also, and this is important, Congress passed a huge tax cut in late 2017 before the tariffs were imposed, which gave the economy considerable momentum, enough to more than offset the negative effects of these relatively narrow tariffs relative to what we're thinking about this time. So this time around, we're looking at potentially much more significant tariffs, and the tax legislation is much less stimulative because it mostly extends current tax policy. If the tariffs are raised to the full extent of President Trump's proposal, it could even result in a recession. This brings us to taxes and spending, the next topic, which is otherwise known as fiscal policy. Now, there's a major difference between tariffs and fiscal policy in that spending and tax changes have to be passed by both houses of Congress. Tariffs, on the other hand, the president can dictate tariff rates. He can dictate which countries and goods they apply to, and when and how to impose them without congressional approval. Now, while Republicans have majorities in both houses of Congress and they have the White House, their majorities are notably thin, and that's especially true in the House of Representatives. Believe it or not, Republicans hold 50.6% of the seats in the House. That's going to make legislation difficult to pass. So on the tax side, the president's going to get the tax cuts that he enacted in 2017. He's going to try to get them extended. He's also proposed additional tax reductions, which I'll go through. Although, again, there's enough Republican deficit hawks in Congress to suggest it'll probably be difficult to get the additional tax cuts passed. So this first tax cut in the first term of Trump was the signature legislation, and it lowered both personal and corporate tax rates. So the personal tax rates were reduced across all income brackets. Estate and gift tax exemptions went up. The child tax credit went up also. The statutory corporate tax rate, which a lot of people don't talk about, was lowered from 35% to 21%. Now, you have to note, though, that there are countless subsidies, carve-outs, deductions, And the actual corporate tax rate, that is corporate taxes divided by profits, is only a little over 12%. Now, a portion of the Trump tax cuts are scheduled to expire at the end of the year, especially on the personal tax cut side. The CBO, that's the Congressional Budget Office, that's a nonpartisan agency that analyzes economic and budgetary issues for Congress, calculated that the full extension of the tax cuts, if it happens, again, they're scheduled to expire at year end, would add $4.6 trillion to budget deficits over the next 10 years. Now, you should note this does not include the other proposals made by President Trump, much of which were almost all of which would further increase government debt and deficits. These include eliminating taxes on Social Security benefits, tips, and overtime pay, cutting the statutory corporate tax rate further to 20% overall and 15% for companies that produce in the US, scrapping the $10,000 deduction, a limit on the deduction limit on state and local taxes, allowing itemized deductions for interest on car loans, extending the child care tax credit from $2,000 to $5,000, and creating a tax credit for family caregivers. There are also a couple of small revenue-raising proposals. One is to impose taxes on large university endowments, and another eliminating the tax credit for electric vehicles. But as you probably know, there's very limited scope for further fiscal stimulus, given the massive increases in our federal debt and our budget deficits that the U.S. has experienced in recent years. So budget deficits averaged 1% to 3% of GDP in the years prior to the financial crisis. But that recession and the COVID downturn, which included massive fiscal stimulus, as you know, brought the deficit to nearly 15% of GDP, which is the highest since World War II. The deficit shrunk since then, but has been over 6% the last 2 years, 6% of GDP. And those are the largest budget deficits outside of recessions in 75 years. These large budget deficits have produced an explosion in US government debt. It increased by over $25 trillion since the financial crisis to an incredible $35 trillion. That's how much outstanding US government debt there is. Interest payments on federal debt obviously have also exploded. They've more than doubled to over $1 trillion, and they're still growing. So this huge deterioration in US fiscal balances suggests that many of the president's proposals to reduce taxes further are unlikely to get through Congress. As I said, I'm not a political analyst, but I think that most, if not all, of the extensions of the Trump tax cuts will be passed. It did have broad Republican support before. I think that'll go through. Now, President Trump, as I said before, has also cited tax revenue as a solution to these budget problems. But as we explained before, it's going to turn out to be woefully insufficient to stop, never mind reverse the growth in federal debt. The president has also created, as you probably know, a Department of Government Efficiency. It's people call it DOGE, D-O-G-E, that initially set a target of $2 trillion in spending cuts. But Elon Musk, who has been appointed to run DOGE along with Ramaswamy, now says a more realistic number is $1 trillion. I think that even that lower number is going to be very, very tough to achieve. And even if they did, it wouldn't put much of a dent in a government debt that's now $35 trillion. The problem is that discretionary spending, that's the amount of spending not dictated by law, has become a relatively small portion of the government budget. And at this point, it doesn't seem excessive. Mandatory spending has accounted for the bulk of the increase in federal outlays, and reducing it would require changes in law by Congress. The CBO just happened to publish its budget outlook last week. It trimmed its cumulative deficit forecast for the next 10 years by about $1 trillion. That's 4%. But that forecast assumes that much of Trump's tax cuts will expire at year end, which probably is not going to happen. More importantly, the details of the report, if you read it, contradict claims made by both sides of the aisle. Turns out, budget problem is not tax revenue, and it's not discretionary spending either. The federal government collects a little over 17% of GDP in tax revenue. That's roughly in line with the average of the last 50 years. Individual income taxes are estimated at 8.7% of GDP, which is above the 8% average. So it's not really tax revenue that's gone down. Discretionary spending, meanwhile, has been shrinking as a portion of government spending for many years. It's now around 6% of GDP. That depends compares to an historical average of about 8%. And as a percent of total government spending, discretionary spending is now about 25%. Used to be about 60%, and if you go back to the 70s. Not only that, but about half of this discretionary spending is defense spending. And with US weapons having been depleted by the wars in Ukraine and Israel, there's a need for restocking. That's going to make it very, very difficult to reduce overall discretionary spending. It's mandatory spending that's the problem. It now accounts for 2/3 of the budget, 80% if you include interest payments, which are not required by law, but functionally they're mandatory. Interest payments are now over 3% of GDP compared with the 2% average. So if you lump mandatory spending with interest payments, which is really what, I hope everybody can hear me.
We can hear you still, Larry.
Okay, sorry. Yeah, I was just told that the thing went black. I'm sorry about that. It's mandatory spending that's the problem, as I said. That now accounts for 2/3 of the budget, 80% if you include interest payments. I already talked about that. A bulk of this mandatory spending is accounted for by Social Security, Medicare, and veterans benefits. Demographics are the main source of the increase. The aging of the US population, reflecting the huge cohort of the baby boom generation that's now retiring, as well as the increase in life expectancy, those are the main reasons why spending has increased so much on these programs. Now, I'm going to talk about the last topic and then open it up for questions. And again, I apologize for the problems I'm having here with the video, but I'm still here. So, the last thing is immigration, and a reduction in immigration is another proposal of President Trump, and it would also have significant effects on the economy. I think people are more aware of the tariffs than the immigration in terms of effects on the economy. As you know, he signed a slew of executive orders on day one. They're going to reduce both legal and illegal immigration, as well as deport many immigrants who are in the US but don't have legal status. The president declared a national emergency at the southern border that will allow US armed forces and the National Guard to be deployed to the border and finish the border wall. The order also includes suspending the refugee admissions program, reinstating the Remain in Mexico program for hearings in the US immigration courts, ending the policy known as catch and release, ending asylum entirely, and creating a removal program without the possibility of asylum. Trump also ordered an end to birthright citizenship, although that is already being challenged in court. While support for immigration policy seems to have declined, from a purely economic view, it's more important now than it's ever been. Immigrants increase our supply of labor, which boosts our supply of goods and services. Among the most critical challenges facing the United States today is its declining population growth, which is lower than any point in its history. Immigration has accounted for the vast majority of our meager 0.4% population growth, which used to be 2%. Without immigration, the US population will start to decline by the 2030s. Already, about half of all counties in the United States are experiencing declining populations. Our labor force has also been growing less than 1% over the past year or so, down from 2% before. The US population is not only aging rapidly, but it is also facing historically low birth rates. Roughly 18% of the US population is over 65, and that percentage will continue to grow over the next 2 decades. These demographics are undermining the financial viability of our vast Social Security program, vast programs like Social Security and Medicare. Many people think that Social Security is a retirement program, but the truth is that payroll taxes flow directly to Social Security and Medicare recipients. When Alan Greenspan chaired the Social Security Reform Commission in the early 80s, the baby boom generation was in its prime working years. The population and labor force were growing much more quickly, and there were a lot less retirees. As a result, the Social Security Trust Fund, which reflects the surplus of Social Security revenues over spending, grew rapidly from 1982 to 2020, but it's been shrinking since then, making it necessary to dip into the trust fund to make the required payments. This system operates kind of like a Ponzi scheme. As long as the labor force is growing faster than the retirement population, the system funds itself. That changed beginning in 2021, and the system under current law is expected to go bust by 2035. There are basically three solutions to these social programs: raise taxes, cut benefits, or open the door to more immigration, which to me seems the least problematic. The problem of a declining population is actually faced by most developed countries, and it's worse in a lot of other countries than it is in ours. China as well is having a problem with this. But the US has a distinct advantage in that most people around the world view the US as an attractive place to live. China and Japan will welcome more immigrants, but are unable to attract them. Immigration has been a boon for the US economy and a major reason for its economic success. There are other factors, of course, like natural resources, a strong higher education system, the rule of law, a strong set of government institutions, and a capitalist economic system. But the fact that the US was built on immigration, where almost all people who reside here either came to the US in search of a better economic future or were born in families that did. And there's a notable exception, of course, in terms of slavery. But that's been a critical factor and still is, even today. And perhaps more than ever, families who have sacrificed by leaving family and friends behind in their home countries expect their children to work hard and succeed. Immigrants are a large component of the US population and workforce. There were nearly 48 million immigrants living in the US in 2023, accounting for over 14% of our population. Most, more than 75%, are in the country legally. There are an estimated 11 million unauthorized immigrants living in the US, most of whom have lived here for many years and have children who are legal citizens. Immigrants make up an even bigger portion of our workforce, over 19%. There's a host of economic data that show the net benefits of immigration to the US economy. Immigrants generate nearly $1 trillion in state, local, and federal taxes, which is almost 300 billion more than they receive in government benefits, including cash assistance, entitlements, and public education. The present value of all tax revenue generated minus all benefits received is positive for all education levels among immigrants, including high school dropouts. Without immigration, the prime age workforce, that's people between the ages of 25 and 54, would have seen essentially no growth at all in the past quarter century, dramatically restricting the ability to grow our economy and staff key industries. Finally, immigration does not reduce the number of jobs available for US-born workers, and it has provided a source of deflationary pressure in recent years. Wage growth has moderated over the past couple of years, despite a very low unemployment rate and strong job growth. And that has been due to a jump in the labor force due to increased immigration. So again, I was going to, we can sum it up. I mean, increased tariffs, a significant drop in immigration would raise inflation and slow the economy, possibly even enough to produce a recession, depending on the magnitude of the actions and their exact nature. And we talked about the federal budget. Probably the most likely outcome is an extension of most, if not all, of Trump tax cuts. won't produce much of a change in the economy because it's simply a continuation of current tax law, but it would increase budget deficits and debt. Anyway, let me stop there. Again, I had a thing on deregulation, but I do want to leave time for questions. So, and again, I apologize for this internet thing. Again, I had to leave my house where we lost service and went somewhere else. Apologies.
No worries. Thank you very much, Larry. We will now move to the Q&A portion of the evening's program. The audience can continue to submit questions via the Q&A function at the bottom of your screen. But Deirdre, would you please ask?
Sure. Thanks, Nancy, and thanks, Larry. That was a terrific presentation. I just wanted to follow up on, you talked a bit about extending the Trump tax cuts and how that's going to affect the deficits in national debt, and also the difficulty in finding ways to pay for those tax cuts. So how do you think investors are going to react to the growing level of our debt? And at what point do you think bond investors revolt? And will the dollar's position as a reserve currency be potentially threatened?
Okay, so that's a good question. And it's a big question.
It's a big question, sorry.
Yes, just so it's about bond investors and I guess the dollar and what that means. And I would say we've already seen something. I mean, if you look at 10-year treasury yields, which is kind of like the benchmark in bond world, it was in the high threes. As a matter of fact, 10-year for 10 years before COVID, believe it or not, 10-year treasury yields they range between 1.5% and 3%, which is remarkably low. We barely were able to get to 2% inflation. COVID's changed things. Firms are no longer using just-in-time inventories in case. They've diversified their supply chains. There's a lot of changes that have gone on. More emphasis on home production rather than just finding the cheapest place to produce. And free trade, tariffs and all that stuff, free trade after growing for years. And that was a big reason why inflation went down. And investors are starting to realize this. The Fed's target for core inflation is 2%. Inflation's been running 3%, which is not bad as long as it's stable, but it's higher than it used to be, which raises bond yields. And there's definite notice that the Treasury is issuing more debt. I mean, it's just the truth. We're very lucky that the dollar is the world's currency and that treasuries are considered the most reliable and safest asset in the world because we do get a lot of foreign participation in the treasury issues debt. But yields have gone up. So I said they were in the threes, mid to high threes. They're now in the high fours. The last I looked at 10-year yields, they were 4.7 or 4.8%. And part of that is worries about the deficit. Now, when you say bond holders revolt, there's one thing that is it's very complicated. There's so many factors and foreign purchases, domestic and other things going on. There's other demands for debt, corporate issued debt, there's mortgage bonds and everything else. But usually, if you want to look at key metrics, one thing I look at is nominal GDP growth versus the treasury yields. When nominal GDP growth, right, that's just total growth in the economy, including prices, is growing faster than the 10-year yield, we're usually okay. So it may sound complicated, but that's sort of a metric I've used that usually works. And with GDP, real GDP is 3%, inflation's 3%. That's about 6% nominal growth or higher. Treasury bond yields are under 5%. Why does that make sense? Because nominal GDP growth is a good guide to where your tax revenue is going to be. You pay taxes based on total income, total spending, which is generally equal to total spending. So as long as that'll indicate that the tax revenue is going up along with it. Now, as far as the dollar, I have a different view on that. I've been doing this a long time. Every once in a while, every few years, this issue rides up. Can the dollar continue to be the world's reserve currency, you know, the main currency that people use to price oil, to price copper, and all this other stuff. Nobody nobody declares this. Why is it that way? And the reason, a big reason is, and it's partly related to what I was talking about before, trade deficits and capital account surpluses. The US has, by far, the deepest and most liquid financial markets, and it's not even close. So our corporate bond market is multiples bigger than any other country. Our US Treasury debt, it's liquid. So if you're China, for example, which has been pulling in dollars because they've run a huge trade surplus with the US, of trillions of dollars in reserves, you have almost no choice but to invest some of that in the US. And so until that, and you know, one of the whole reasons for the Europeans to form the euro was to try to challenge the dollar, but they never formed a European bond market. You know, there's Italian bonds, German bonds, French bonds, you know, and that would have increased liquidity of bonds and been a whole different things. The Germans were against it. There were some ideas. I actually pushed one that could have made it happen, but it didn't happen. So there is just no country like the US with that. And so it's just that people want to use dollars. It's also the most stable, reliable currency. So those kinds of things would have to change. Now, who knows? In 50, 100 years, maybe it will, but it's not going to happen anytime soon. So anyway.
Great. Thank you.
Larry, I have a question that someone put in the Q&A.
Yep.
If one expects Trump's new tariff policy and tax cut policy to go into effect to any significant extent, generally speaking, will that more adversely affect U.S. equity markets than non-U.S. equity markets? And should one significantly increase the percentage of fixed income in his or her portfolio versus equities? In other words, in anticipation of Trump's policies taking effect, generally speaking, how should people adjust their portfolios now?
Right. It's a good question. And it's a tough one because, look, as I said before, you know, he is someone who seems to change his mind sometimes. And, you know, one thing I will say, we have, you know, for doing these things, now tariffs, he can really have a lot of power over, unlike, you know, the tax and spend side, which would have to go through Congress. But he often in his first term cited the stock market. And I think he cares about that. He sees that as a metric of his success or failure, or whatever. And, you know, if it does start going down, I think, and he is convinced that the tariffs are part of that. And I do believe that, I mean, 60% tariffs on China would be an enormous, I don't know if you buy stuff over Amazon, probably everybody on this call does. I'm amazed at how many, when I buy little things, it says made in China. I mean, it is cheaper and would have a really big effect. Now, I would, and then that gets me to the discussion. What's important also is how fairly is the stock market valued now is part of the answer to that question, because it's not going to just be tariffs that'll determine whether you should shift that allocation or not. And one of the problems with shifting it is, if you do shift it, I would stay in the shorter end of the curve. In other words, lower maturity fixed income, because I do think we've already seen bond yields go up. And if you put tariffs up, inflation's going to go up, bond yields will go up more. That'll mean the price of the bonds go down and the value of your bond portfolio will decline, even though once the high yields get there, you get more money. During the transition, your bond fund goes down, if you see what I mean, because the prices of the bonds go down and the yields go up. So that makes that part, you know, we did go through a period, you remember, of both bond yields and the stock market, bond yields going up and stock market going down. That happens sometimes. So that's a problem. Now, the other thing is that stocks are, if you look at your valuation metrics, price to earnings, price to book, all those things, they're on the high side. They're pretty high. Now, a lot of that, I think, has to do with AI, which is interesting. And I believe, I don't know what, you know, I mean, there's different opinions on that it's a real thing. But let's go back to the tech bubble. The internet was a real thing. It had a massive impact on our lives, right? But stocks still got overvalued. Any company had anything to do with the internet was getting valued, even if it had no revenue, if you remember. And the bubble crashed. Now, there were winners and losers, and a lot of tech firms, and we know the names, Google and all these, there's Alphabet and Facebook and Netflix, and, plenty of Amazon, the internet was the real thing. It feels like that with AI. In other words, I think AI is the real thing. I think it is going to have a big change. It's going to take a while to implement it and get it used by everybody, but I think it's a real thing. I don't think the increase is over yet. So I do think this has a ways to run. But would I be shocked if we get a crash at some point? I wouldn't, especially given the high valuation of stocks right now. And I think Trump tariffs would be damaging to the stock market for sure. But I think it would also raise bond yields. So I think there's almost no place to hide except at the short end of the curve. Because if inflation goes up, that also means the Fed won't cut rates as much, which I already believe. I think they're almost done, actually. So staying at the short, if you're going to do that shift, and let's also face the fact that the older you get, stocks are higher risk, but higher return over the long run. And you're supposed to reduce your stock allocation a little bit, as you age. So again, it probably makes sense given the valuations, depending on how cautious you are, what's your risk tolerance. It is true over the long run, stocks return much more than bonds. So, if you can afford to stay patient and go through the downside, but at some point we're going to get a stock correction for sure. It's hard to see it in the near term unless Trump goes all the way with this stuff. Then you could see a recession. So I don't know if that's a helpful answer, but I don't have a stock answer. I'm trying to give you the different influences that could, whether you believe Trump's going to do all this or not, and that kind of thing.
Exactly. Thank you. Great.
Great. And Larry, could you talk a little bit about the deregulatory agenda of the new administration and what industries might see the biggest impacts?
Right. So look, this is one area I'm pretty sympathetic actually to the desire to cut back on regulation. I mean, I was going to mention a statistic here. So the Code of Federal Regulations, get this, has ballooned to more than 180,000 pages. They affect almost everything we produce in our economy. And in some circumstances, their complexity, especially when you layer them on top of state and local rules, can make it difficult for businesses to operate and new and much needed construction and infrastructure to be built. I'm sure you've all had experience with some regulations that make things a lot more difficult than they need to be. At the same time, we need regulations to keep our food supply, our cars, our airplanes, our financial markets and institutions, our pharmaceuticals, our workplaces safe, our environment cleaner. So you need regulation. We've probably gone overboard on a bunch of stuff. I think, it's tough to get regulations repealed. The Trump administration did not have a good record in the first term in terms of they won only 20%, 22% of the lawsuits that were, the challenges they had to reducing regulation. And there's a lot of hurdles to getting rid of them. You've got to you got to make a public notice. You have to provide an opportunity for public comment. You have to have a statement of the basis and purpose of the regulatory rulebook. There's all kinds of things like that. So I'll just go through quickly, if I can, three different industries that I think. One is obviously, the electric vehicle stuff, which Trump he's already revoked an executive order that was made by Biden that sought to ensure that half of all vehicles would be sold in the US would be electric by 2030. He's ordered the suspension of unspent funds for electrical vehicles charging stations. He plans to direct the EPA to reconsider mandates for more stringent emission rules, and he wants to eliminate the $7,500 federal credit for EV purchases. But on that case, that's going to be challenged, and not just by environmentalists. It turns out that the car makers themselves were very supportive of Biden's 50% mandate. Why? Because they've already invested tons of money in electrical vehicle production. So I think he'll do some of it. I think it's going to be tough to get all of that, especially with the car makers, and he does care about business, so heavily invested in electric vehicles. The energy thing, that I find amusing, this drill baby drill stuff and the declaration of an energy emergency. He's pledged to expand oil production, make the U.S. the dominant energy producer, achieve energy independence, roll back Biden's clean energy initiatives. On the clean energy initiative, there's investments are already underway and have already been subsidized. So I don't know how much you can stop them. But I'm not clear what he means by an energy emergency. All those things I just listed are already happening. The U.S. is already producing record amounts of oil and natural gas. We are by far the biggest producer of oil and natural gas in the world. We are energy independent already. We became a net exporter of natural gas in 2017. We became a net exporter of oil and other petroleum products in 2021. So, as you know, a lot of this is the result of the shale boom and advancements in hydraulic fracking. To tell you the truth, right now, there's only one way. In Texas, the natural gas companies are actually losing money because they're producing so much natural gas. The only way to induce companies to produce more energy at this point in the U.S. is if global prices rise. And I doubt the Trump administration would want that. So the whole thing is kind of wacko when you actually look at the data on what's going on in oil and gas, because we are already drilling like crazy. So that one, I don't see that thing going anywhere. Now, bank deregulation, and I worked for JP Morgan and Barclays, and it depends on exactly what regulations are rolled back. It could be helpful for actually banks and financial markets and even investors, because the Dodd-Frank bill, as you know, which passed after the financial crisis, forced banks to hold a lot more capital and use less leverage to ensure their safety. And it's been, by the way, it's largely succeeded. I mean, big banks are better capitalized than they've ever been. But one of the side effects has been bank inventories of securities are much smaller because they have to hold capital against them, and a lot of capital. And that's made markets more volatile. So they're not able to go in there to quell market disturbances because they have much less inventory. It's important to have inventories because when investors want to buy or sell, they've got them. So I think maybe some loosening of the capital requirements in certain markets. Again, I'm not saying let's go back to pre-Dodd-Frank, but in certain markets like the repo market could improve liquidity and reduce volatility. So I think there might be some promise there on the bank regulatory side. I hope that's
great. Thank you.
Okay, Larry, I think this is going to be the last question because
we're
up to what's almost 6:40.
Yep.
You have to go.
Yep.
Okay, I agree regarding the negative impacts of tariffs, debt, immigration crackdown. How do you assess the offsets of deregulation and higher, quote, animal spirits because of Trump being pro-business?
Yeah, I honestly, again, I listed a whole bunch of hurdles. It's not, I think Musk and Ramaswamy are going to be pretty frustrated by trying to get these things through. And the other thing that I was talking about, which is very relevant, is it's only the discretionary spending that you can really do. Half of that's defense, which, you look at our defense arsenal. If anything, we got to increase defense spending. I mean, we've lost a lot of weapons, sending them to Ukraine and Israel. So and Trump is a big defense, hawk usually, he wants to build defense. So getting discretionary spending down, and getting a lot of these, which is not the same as the regulation, but I do think it's going to be a tough go for them. I think they will get rid of some regulations, and I think some of them could be very helpful. Um, do I think it's anywhere near enough? Again, we're talking about that, relative quantities, and that's critical. So, if Trump does all, 60% on China, 25% on Canada and Mexico, and 10 to 20% on everything else, forget about it. I mean, there's no deregulatory regime that offsets something like that. You see what I mean? But if it's a lot less than that, what I would say, just to give a bottom line to you, is it's possible that it'll provide some offset. Some offset. Do I think it can completely offset? I doubt it. I doubt it very much. Especially, and I'm, if anything, just as worried about the immigration, because remember, I was talking about what's going on with our population and our labor force. And it's very interesting. You ask any economist who's been following things, how did we get a moderation in wage growth when we have super strong job growth and the unemployment rate's around 4%, which is full employment? And it's because the labor supply has increased. And when you do the research on why the labor supply has increased, it's been because of more immigration, which is already being reduced, by the way, which you'll see in the labor market. It'll make it tighter. So I think that's a big thing. Immigrants they're 19% of our workforce. It's big. And I don't think people realize that. And it's not just in farming, even though they're like 2/3 of crop employment. They're very big in a lot of areas like construction, maintenance in many places. So I think I think you should be just as worried about that. And I'm not even talking about the ethical or social things. I'm talking about just the economic impact of that I think people are underestimating that. I think people are very aware of the tariff potential damage and less aware of immigration. I may be wrong, but that's my sense of the damage to the economy from lower immigration. I think is a big issue.
Very, very good. Larry, thank you so much. There were so many more questions we couldn't get to. But on behalf of the League of Women Voters of Greenwich, I want to extend our heartfelt thanks to you for sharing your insights on such an important and relevant topic. Your presentation has been both illuminating and thought-provoking, helping us better understand the economic landscape and what may lie ahead. Thank you to everyone who joined us this evening. We hope you'll continue to participate in future League events. Have a wonderful night. Thank you.